The U.S. has started a war against China and the CCP's ambitions. Not the typical military war involving guns and missiles, but a new type of war. It involves AI, semiconductors, high tech, and top-level politics. Following the announcement of a powerful new cloud computing system geared for artificial intelligence projects by the Chinese e-commerce giant Alibaba, the United States responded by proposing new export restrictions that will make future initiatives like that unlikely. The rules imposed by the Biden administration prohibit corporations from shipping advanced processors required to train or run the most powerful AI algorithms to China. The law also bars U.S. individuals, including U.S. nationals and green card holders, from providing support for the development or production of chips at certain Chinese manufacturing sites. Chips are required for everything, from smartphones and self-driving vehicles to sophisticated computers and weapon manufacturing. Officials in the United States have described the decision as a precaution to defend national security interests. It also comes at a time when the United States is aiming to invest heavily in domestic chip production, following chip shortages earlier in the year that highlighted the country's reliance on imports from abroad. Previously, the U.S. government prohibited the sale of particular tech products to Chinese corporations such as Huawei. It has also forced some large U.S. chip-making companies to cease exports to China. However, the most recent migration is far more extensive and consequential. It not only prohibits the export of advanced semiconductors created anywhere in the world using U.S. technology to China, but it also prohibits the transfer of the equipment needed to make them. Beijing has established a goal of becoming a worldwide leader in a wide variety of industries, including artificial intelligence or AI, 5G wireless, and quantum computing, via its Made in China 2025 roadmap. Xi stated during the Communist Party Congress, when he secured a record third term, that the country will promote technology and innovation, as well as expand its talent pool to produce domestic innovations. China will look to join the ranks of the world's most innovative countries by 2035, with great self-reliance and strength in science and technology, Xi said in the Party Congress report released on October 16. Given the importance of advanced chips in both areas, the current U.S. restrictions will make it more difficult for China to develop AI and 5G. The regulations are also intended to make it far more difficult for China to build supercomputers with military applications, ranging from nuclear bomb simulation to hypersonic missile development. The limits represent a fresh move to distance China from the United States in cutting-edge technology. The announcement occurred just days before the Chinese Communist Party's 20th national session, at which President Xi Jinping was re-elected for a third term. The regulations will have a wide-ranging impact on Chinese businesses. They will ban U.S. companies from exporting crucial chip manufacturing tools to China, affecting companies such as Semiconductor Manufacturing International Corp., Yangtze Memory Technologies Company, and Chengyin Memory. The limitation will also prevent U.S. persons or American citizens and businesses from directly or indirectly assisting Chinese firms involved in sophisticated chip manufacturing. According to Kevin Wolf, an export control expert at Aiken Gump, the U.S. Person Clause was the most significant and expansive component of the comprehensive package of measures outlined. He described the technique as novel since it risked sanctions even though the underlying technology was not subject to existing export controls. In addition, the U.S. placed YMTC, along with 30 other Chinese firms, on a list of unverified companies, setting the road for possible inclusion on a second blacklist known as the Entity List, which would essentially prevent U.S. companies from supplying them with technology. The administration's objective is to prevent China from indigenizing its semiconductor industry. If the U.S. is successful, Beijing's aim to become a world-class player would be severely hampered. To emphasize the extent of the regulations, the U.S. is employing a broad mechanism known as the Foreign Direct Product Rule to make it more difficult for China to create and maintain supercomputers and AI technologies. The law, which Donald Trump's government initially used against Chinese technology firm Huawei, effectively prohibits any U.S. or non-U.S. corporation from supplying specified Chinese companies with hardware or software whose supply chain includes American technology. However, in order to prevent supply chain disruptions, the administration will make an exception for chip-making facilities in China controlled by the U.S. or allied corporations that export chips. Analysts predicted that China's memory chip makers, such as YMTC and Changyin Memory, would take the greatest immediate hit. Because U.S. equipment manufacturers have a stronghold in a few critical niches, the prohibition on the export of semiconductor tools might considerably harm Chinese chip makers. The restriction will inevitably delay China's advancement in semiconductor technology, but it will not halt it. Instead, it is more likely to allow U.S. producers time to gain a technological advantage over China and establish what Washington considers a safe distance in capabilities. The export prohibition will also harm China's aspirations to establish self-sufficiency in chip manufacturing, which is also a declared objective of Russia. The etching of exact patterns on silicon wafers is a skill that China has yet to perfect, and for which it is heavily reliant on international equipment. The restrictions effectively prevent China from acquiring that method until they are able to create a solution to this process themselves. However, although the longer-term geopolitical competition is focused on AI, there are also implications for global businesses where the U.S. wants to be dominant, such as electric vehicles. To put it in context, there are around 1 billion gasoline-powered cars worldwide. This is predicted to fall by half by 2030, implying a potential growth market of the 500 million EVs between now and the end of the decade. Washington expects its manufacturers to grab the lion's share of it, at least in the regions over which it has political power. Washington has also put pressure on chip manufacturing and related businesses in Europe to guarantee it gets its way. AMSL of the Netherlands is the world's largest provider of advanced chip-making equipment, and Washington has threatened the business with exclusion from the U.S. market unless it stops selling to China. This sort of conduct is common among other manufacturers, albeit it also affects Japanese and South Korean manufacturers. Taiwan, which is already heavily influenced by the U.S., will just follow Washington's lead. It is not to argue that the ban is a blanket restriction against China. Exemptions have been provided to assist in safeguarding enterprises whose China trade in semiconductor technology is large and where shutting off that income stream may result in a significant cash flow damage. With regard to China, the administration spent months in talks with allies such as the Dutch, Japanese, South Korean, Israeli, and British governments, attempting to persuade some of them to impose restrictions alongside the U.S. However, several of these nations have been unwilling to break vital trade ties with China, one of the world's largest technology marketplaces. As a result, the Biden administration opted to do it alone, without public support from friends. While the current limitations are being debated internally, Jake Sullivan, Biden's national security advisor, delivered a speech in which he invoked the sanctions imposed on Russia after it invaded Ukraine. They were the most stringent technology restrictions ever imposed on a major economy, he said. These measures have inflicted tremendous costs, forcing Russia to use chips from dishwashers in its military equipment. He went on, "This has demonstrated that technology export controls can be more than just a preventative tool. If implemented in a robust, durable, and comprehensive way, they can be a new strategic asset in the U.S. and allied toolkit to impose costs on adversaries and even over time degrade their battlefield capabilities." Former Defense Department official Gregory C. Allen, now at the Center for Strategic and International Studies, said the decision was made after dialogue with allies but was fundamentally unilateral. In weaponizing its dominant choke point positions in the global semiconductor value chain, the United States is exercising technological and geopolitical power on an incredible scale, he wrote in an analysis. The restrictions empower the government to bar China from purchasing some advanced semiconductors created by American and foreign businesses that use American technology. Officials in the United States viewed the move to impose export limits as a display of leadership. They said that several partners wanted to impose similar regulations but were afraid of retribution from China. So Washington's restrictions, including international corporations, performed the hard job for them. There's also the issue of foreign-owned chip makers headquartered in China. For these, The U.S. Department of Commerce has established a window through which they can request approval to continue receiving U.S. or other foreign imported equipment, implying that sales will be vetted in terms of what can and cannot be delivered. Some of these windows have already been opened, such as the one granted to Taiwan Semiconductor Manufacturing Company, or TSMC, the world's biggest contract chipmaker, for its Nanjing manufacturing hub. South Korean memory chipmaker SK Hynix, located in Wuxi, confirmed receiving a similar window. This does, however, imply that the U.S. will be watching closely to see what is delivered to China.